Hey guys, welcome back to another episode of Technical Tip Tuesday. This week we're going to cover Fibonacci retracements. We're going to go over how to properly place them, how to best represent the market trend, and how to trade them. So a Fibonacci retracement is a tool used to track the retracement of a move from its starting point. So if, say for example, we make a move from $50 to $400, right? We slowly make our way up, right? But ultimately it's a move from here to here. The Fibonacci retracement is going to show us our progress from the 0% retracement mark back down to the 100% retracement mark. A 100% retracement would mean that you came back to your original starting point. A 0% retracement would mean that you didn't pull back at all. Okay, so let's look at some examples here. So it's important to note that when you're using Fibonacci retracements, you can use them starting from a high to a low or from a low to a high. And differentiating which way to go is going to save you a lot of heartache, because one of the most common mistakes I see when people are placing Fibonacci retracements is to use them in the wrong direction. So if you ever get confused, just think, if you want to track the retracement of a bull move, you're going to start at the beginning of the bull run and you close it out at the end of the bull run. And vice versa, if you want to track a bear run, you track it from the beginning to the end, right? The 100% retracement should be your starting point, and the 0% retracement should be the peak of your run. Okay, so let's lay out some macro Fibonacci lines for Ether's current bull market it's in. Even though, if you look at the smaller time scales, maybe the 1 hour, the 2 hour, it can seem a little bearish right now. Overall, it's important to keep in mind that we are in a bull market. So let's look at some Fibonacci retracement lines for the current bull market we're seeing. So really, I'm going to consider the bull market, just for the sake of this argument, to be this move right here. So it's going to track everything above the 50 line, because that's when it really broke out and just kind of started having these big market swings. So let's start the Fibonacci retracement set from 50 and drag it all the way up to the all-time high at 420. Okay, let's move this over. You can see here the market lines up very nicely, but it doesn't fully represent the move, right? You only see one touch of the zero. You see a couple of the lines not really getting much bounce on them. So let's go ahead and I'm going to walk you through the process that I like to use for kind of zeroing in your Fibonacci lines so that it best represents the market, right? Like, we can always put Fibonacci sets on anything, but the important thing we should be asking ourselves is, does this best represent the market? The goal of the Fibonacci set is to represent the support and resistance lines. And although they don't always fall in the Fibonacci retracement sets, very commonly they do, and they can be a very powerful move for gaining insight into the next moves the market will make. So looking at this set here, let's go ahead and make some notes about the current set we're seeing here. Okay, we see the all-time high here. We see the beginning of the run here. Okay, cool. But what we don't see is we see a lot of these like outliers here that aren't really being supported. We see an outlier here that's not really being resisted here. And same here. And not only that, but we see a very crucial pivot point here not being represented with this macro Fib set. So let's go ahead and see if we can best represent this set in a different light. So we're going to go ahead and leave the starting point here and kind of drag the Fibonacci set and test it right here so that we can get two market touches on the zero line. And how does this look? It looks a lot better. So let's go ahead and compare and contrast here. So here's the zero at the 420, and here's the zero at the 403.97 mark. And we can see here that there are more touches on the line if we zero it in here. So pay attention right in here. I'll draw a little square for you guys. So let's pay attention in this zone right in here. Okay, so as we zero it in, watch how these lines start to find resistance here. Okay, so we zero it in and boom, we get nice resistance here, we get nice resistance here, we get nice support, and you can see the Fib levels is a more accurate representation of what the market is actually doing right now. It's important to keep in mind that when you're using the fib sets or resistance lines or support lines, that the higher the time scale, the more relevant the support and resistance lines are, right? So in this example, we're looking at the 1-day candles. So that means every candle in this on this chart represents 1 day of market activity. So you can think, you know, just from a logical deduction. This is the way I always like to look at things. I have to like break it down and really make sense of it. So the reason why the macro scale takes such precedence over the micro scale is because if we look at, for example, let's go ahead and just draw a support line here. I'm sorry, a resistance line here. So, for example, let's go ahead and look at this resistance line here. Just putting the Fibonacci set aside, let's go ahead and look at this guy right here. Okay, so we see here on the 1-day candles, we only see 2 tests right here, 1, 2. Okay, so on face value, it kind of seems like, okay, well, there's only 2 tests there. How strong can that really be? So if we look at the 6-hour, for example, we see a couple of candles actually tested this value. So we see, you know, 1, 2, 3, 4, arguably 5. So we see 5 tests of this line on the 6-hour. And likewise, if we zoom into the 4-hour, we see a couple more candles. And if we zoom in closer, you'll actually see that the reason why the 1-day candle is so representative on this line and so relevant to our current market trend is that as you get closer, say hypothetically we zoom into the 15 mark, you would actually see a lot of tests of this line. And it was so many tests that on the larger scale, as you zoomed out, it represented one giant test on the 1-day candle, you know. So that's important to keep in mind, that as you're looking at the macro scale, you know, this takes precedence and is a much greater milestone to break it or find support on it, right? So as you see a move, breaking a support line on a macro scale is very telling for the direction of the market. So that's just something to keep in mind. So let's go back to our current fib set and see how we can apply this to the current market. Okay, so we're starting again at 50. We're going to go up to the 400 because you've already zeroed this in. And we see here that the current market is sitting right in between the 23% retracement and the 38% retracement. So no macro support on the much greater scale is seen here. But sometimes, like I said before, you can find retracements from the bull run and the bear run. You can find fib sets from other little runs, right? So if we look at this whole market, we can think of this as one giant bull run. So one bull, right? But within this one bull, we actually have a couple other bulls. So we see one bull, we see one bear, we see one bull, we see one bear, and likewise one bull. And now we're seeing one more bear. So although we're in a macro bull market, it's actually comprised of these smaller little bull runs. We see 1, 2, 3 bulls. So 3 bulls. And 1, 2, 3 bears. 3 bears. And every single one of these runs, we can use a fib set to draw support and resistance for our current, for the relevant market. So in this case, because we're moving downward, okay, let's go ahead and zoom in a little bit closer on our current market we're seeing. Okay, so it peaked out at 396, and it bottomed out at 200, and now it kind of bounced back up. So this is a bear run, and now we're retracing the bear run, and we're kind of bouncing back and forth here. So let's go ahead and see what insight we can draw from here. So we'll start here, go down to the bottom at 200. Let's see what we're looking at here. All right, aha. So now we see, now that we looked in a little closer, we actually see that we're testing resistance, 50% resistance of this little bear run right here. So we're in the process of retracing it, and now we see here we're finding resistance on the 50% line. So you can imagine that a break above this is going to be, you know, for the sake of this move, this little market that we're seeing here, this is going to be a pretty big deal, and we can expect to see, you know, a kind of a choppy market. Once it breaks this resistance level, we can expect to see a choppy market in here before it breaks the next resistance level. So let's go ahead and put this into context. So keep in mind, these are 6-hour candles I'm looking at here. Let's go ahead and put it into context within the 1 day. So we see here that overall, you know, it's finding support and resistance along these lines, and we can see it on the pivots too. So we see here it bottomed out, it came up and it found resistance here. It bounced down, didn't quite make it to the 23%, and then it came up, and it's been finding support and resistance along these lines every step of the way. And now we're testing this 50% for the, what, 6th time? 1, 2, 3, 4, 5, 6. So one key characteristic of a Fibonacci retracement set is that it's fractal. So as I mentioned earlier, the macro fibs, they take precedence over the micro fibs. You know, this being the macro, this being the macro here, this being the micro. The larger span is going to take higher precedence over the smaller span. Okay, but what's really great about Fibonacci sets is that they're fractal. And what do I mean by that? I mean that they apply on all time scales, but what's important to note is that their relevance in the overall market picture vary depending on how zoomed in you are in the graph, right? So like I said before, the macro takes precedence over the micro. So you can imagine if you zoomed in, for example, to the 30-minute chart, right? We can plot a fib set on this, and it matters, and it is relevant for the 30-minute candles. So let's go ahead and look here. Right, so we draw a fib set here, and we see nice support and resistance along the fib set. Okay, but when we zoom in, we put it in the context of the overall market. You know, we go back to the 1-day candles. This doesn't mean a whole lot, right? The overall market dynamic is not affected in the grand scheme of things by the small scale. So when you're using fib sets, it's important to keep in mind and put into context what you're personally trading. So if you're looking to take multi-day positions, maybe multi-week positions, you know, maybe you only look at the charts every couple of days, every couple of weeks, you know, zooming in this close to the 15-minute candles or the 30-minute candles, not going to provide a whole lot of insight in terms of what you're trying to do. But if you're a day trader, this can be a really powerful tool for entering and exiting, you know, quick turnaround positions. Okay, so keeping along the same example here, let's go ahead and look at. So let's go ahead and put into context this bullish move here, and look at it in a different light. Okay, so we can look at this little bounce. Right, so we bounced from 275, bounced up to 311, but this whole move right here is actually comprised of 2 moves, right? So we can look at it like this: 1 move upward, this is 1 bull, and then 1 move downward, this is 1 bear. So depending on how you're looking at this market, you know, you can gain insight into 2 different perspectives. So one perspective being this fib set from here to here, right? Shows great support and resistance. And then you can also do it for the bear. So you go down from here to here, and it shows equally relevant support and resistance depending on how you want to view the market, right? So when you're looking at fib sets, a lot of times conversations that I encounter in my trading community, for example, people have varying fib sets, and they're confused about, like, well, is my fib set right or is my fib set wrong? And a lot of times it's just that traders are viewing it through different lenses. So what I always like to tell the people in my trading community is that If you think you're right or you think you're wrong, just start big and move in small, right? So start on the 1 day and build your fib sets from scratch. So let's go into a trading example. Say we're looking to day trade the current market, right? So even if I'm looking to day trade, as I said before, the larger timescales take precedence over the smaller timescales. So we want to see if there's any macro support or resistance that's going to affect our current moves. Okay, so we got this fib set right here. Cool. And let's go ahead and plot this fib set right here from here to here. And it's going to start getting cluttered, but as we zoom in, it kind of clears out. And then let's go ahead and drop to a much smaller time scale, like the 1 hour, maybe even the 30-minute. Okay. So we see these macro support and resistance lines. Let's go back to the 1 hour. So we see macro support and resistance lines that could potentially affect a move. And let's say we wanted to day trade this current little pop-up from 275 to, what was it, 311. Okay, so let's drop to the 30-minute candles and let's plot our fib lines here. So what do we see? We see here that in this current band right here, we can look at this as like a little band. There's going to be heavy resistance here, and we can expect there to be a lot of effort required of the market to break above these values from 297 to 299. This is going to be strong resistance, because even on the small scale, going up to the big time scale, the 50% on the macro scale, this is going to provide a lot of resistance. So, as the values approach this 297, 299, it's important to keep in a perspective that maybe this isn't a good move to go long up in here, because it's going to take a lot of effort and it's most likely to bounce down. Or another way to word it is that maybe if you're looking to go long, maybe wait to break above this band of resistance and have confirmation that the market finds support. So it breaks up and comes down and finds support here, establishes support and moves up to go long. In trading, we want to think about maximizing our optimizing our risk to reward. And typically, it's not a good idea to go long or go short when your back is next to support or resistance. So if you're butting up against resistance here, up in here, it's probably not a good idea to go long. And likewise, if it breaks above here and finds support on the 50% line, probably not the best idea to go short, because it would take a lot of market effort to break below this. So now that we've discussed how to place fibs for the bear and bull runs, let's go ahead and break down some strategy for bulls and bears. So one thing I've noticed through trading this crypto market is that bulls, I'm going to go ahead and draw this out for you guys. So bulls love 23% retracements and 38% retracements. So what does that mean? If we have a strong bullish move, typically for a continuation pattern, the market's going to go up. Then retrace back down to the 38% and continue. And so we can imagine that we can use this as a sign of momentum. In the previous Technical Tip Tuesdays, we talked about MACD divergence. We talked about RSI divergence. We can use the same idea of maintaining momentum for a move with fib sets as well. So if the momentum is being maintained for a move, what we should see is that during bullish moves, like from here to here, for example, we see 38% retracements before continuing upward, right? And this happens over and over again, even on smaller time scales like your 15-minute candles. So typically what we see is the market moves up and it retraces 38%. It moves up and it retraces 38%. And as it starts to struggle to make new highs, we start to see a weakening of the 38% retracement. So let's just go ahead and do a hypothetical example here. So we have our fib set here, and during a healthy move, what we want to see is we want to see the market come up, peak, and then retrace to the 23, bounce, go down to the 38, and then continue upward. But if the market's struggling, what we start to see, if we're losing bullish momentum, so it comes up, right, it comes down, it bounces, and then it starts to dip down to the 50. And this is a good indication that the seller momentum is starting to pick up and the bullish push is starting to wane, because it's no longer being propelled upward. So this is a good indication that maybe we should start looking to start subtracting from our long, maybe starting to look to go into a short position maybe. And yeah, it's just a great indication. And you know, vice versa, if it only retraces to the 23 and it starts to retest the high, this is a strong bullish move here. So remember, bulls like the 23 and the 38%. However, something that I've noticed is that bears love the 61%, the 50 and the 61% retracement. So if we're doing a bear move from here to here, very commonly what we see in a bear market is that the bears come down, they bottom out, and they do this stepwise testing of the fibs all the way up to the 61 before continuing. So it'll do something like this. This happens over and over again. So it comes down, hits the 0, comes up, hits the 23, comes up, hits the 38, the 50, the 61, maybe tests it again, and then it goes stepwise down before continuing downward. So let's look at a couple bearish moves that retrace the 61%. So at the last peak, entering into our previous bear market, we topped out at 396. We bottomed out for this move at the 285, and we see here that the market retraced to the 50. Remember how I said bears love 50 or 61%? We see here that the market retraced up to the 50% before continuing downward. It also did it right here, right? So we moved down, then it bounced up, hit the 61, retraced it, and then continued downward. So we see here that it peaked, moved down, and then it moved up, and it retested these moves all the way down before continuing downward. And if we apply the fib set starting here, for example, we look at it like, remember how I said we can look at it through different lenses? We can look at it like this. So we see one big bear run, or we can see a couple of different smaller bear runs. We see one bear run, two bear runs, three bear runs, 4, 5. And we can apply fib sets on all these, and they all work out very nicely. So we see 1 to the 61, 2 to the 61, 3 to the 61. It retested the 38, and then it continued upward. So that signaled the bottom of our bear run. It's important to keep in mind that there's a lot of nuance when trading fibs. It's not as simple as just placing, you know, top to bottom or bottom to top. It can be infinitely as complex or simple as you like. It just depends on how advanced you want to. It just depends on you know, how in depth you want to go into with your application of fib lines. Totally okay to place it as support and resistance, but it can be a very powerful tool to gain insight into where the market's moving and the health of a move. So that wraps up Technical Tip Tuesday. If you liked what you heard and you found it useful, you know, feel free to drop me a like on YouTube. You know, share it with your friends. And you know, if you want more information outside of the Technical Tip Tuesdays and you'd like to join the Discord network, those links are available in the description below. And yeah, as always, thanks for your support, and I'll see you next Tuesday.